Your lender is not your advisor, and the sooner business owners understand that distinction, the better positioned they become to protect their companies, structure their capital properly, and avoid costly financing mistakes. Banks and lenders often present themselves as long-term financial partners. They speak about relationships, growth, and support. They call to check in, invite clients to events, and position themselves as trusted resources for businesses. But behind all of that relationship building is an important reality that many entrepreneurs fail to fully understand. Lenders do not work for you. They work for the institution that employs them. Their responsibility is to protect the lender's capital, ensure compliance with internal credit policies, manage risk exposure, and satisfy institutional underwriting requirements. That does not make lenders dishonest or malicious. It simply means their priorities are fundamentally different from yours. A lender's role is to determine whether your transaction fits within their institution's risk appetite and lending parameters. An advisor's role is to determine how your business should position, structure, sequence, and present the transaction to maximize the probability of success while protecting your long-term interests. Those are two completely different functions. Yet many business owners walk into lender meetings expecting strategic guidance, only to discover too late that they were receiving a credit opinion, not real capital advice. One of the most damaging assumptions entrepreneurs make is believing that if a bank declines a deal, the project itself must not be financeable. In reality, many viable transactions are rejected every day for reasons that have little to do with the true strength of the opportunity. A deal may fall outside a lender's policy limits. The timing may not align with the institution's market appetite. The industry sector may be considered too specialized. The leverage may exceed internal thresholds. The borrower may have presented the information poorly. The transaction may require a structure that the lender simply does not offer. In many cases, the issue is not the opportunity itself, but rather the way the opportunity was positioned, packaged, or introduced to the market. Sophisticated companies understand this. They do not approach capital markets blindly and hope a lender tells them what to do. They prepare in advance. They identify weaknesses before the lender identifies them. They understand how the transaction will be perceived by credit committees. They know which lenders are appropriate for the opportunity and which are not. Most importantly, they recognize that financing is not simply about getting approved. It is about obtaining the right structure from the right capital source under the right conditions. Wrong financing can destroy a business even when the company itself is fundamentally sound. Poor covenant structures can limit operational flexibility. Aggressive amortization schedules can suffocate cash flow. Excessive reporting requirements can create unnecessary administrative burdens. Improper guarantees can expose personal assets unnecessarily. Short-term debt used for long-term projects can create refinancing risk that becomes catastrophic later. Yet lenders are not necessarily responsible for protecting you from those outcomes. Their role is to lend according to institutional guidelines, not to architect your long-term capital strategy. This becomes even more critical in specialized or complex industries, such as construction, cannabis, development, hospitality, manufacturing, turnaround situations, asset-based lending, or cross-border transactions. These are not simple plug-and-play financing requests. They require careful structuring, sequencing, narrative control, and strategic positioning. The lender only evaluates what arrives at their desk. They are not responsible for building the framework behind the transaction. That responsibility belongs to the borrower and their advisory team. That is why businesses with similar financial performance can receive dramatically different financing outcomes. One business enters the market reactive, disorganized, and desperate for capital. Another enters with a clear strategy, institutional quality presentation materials, realistic assumptions, and a properly structured execution plan. The difference is not always the business itself. Often, the difference is preparation. At Equis Capital Finance, this reality is precisely why Project Navigator trademark was created. Before approaching lenders or investors, businesses need an honest assessment of whether the transaction is truly financeable, how it should be structured, what risks must be addressed, and which capital sources are actually appropriate for the opportunity. Project Navigator trademark is designed to identify weaknesses before the market does, improve capital readiness, strengthen lender positioning, and help businesses approach financing strategically rather than emotionally. If you are serious about raising capital, stop relying on lenders to tell you how to structure your future. Start with a strategy first. Project Navigator trademark was built specifically for that purpose. Visit Equis Capital Finance to learn more about Project Navigator trademark and how Equis Capital Finance helps businesses prepare, position, and structure transactions before they ever reach a lender's desk.